Good morning and welcome to the Killik & Co market update. Over the last few weeks, we've seen a sell-off in bonds and therefore a rise in bond yields. And this can happen for a number of different reasons. If investors are expecting a rise in interest rates or inflation, then holding a bond with a fixed rate of return becomes relatively less attractive, and therefore investors are likely to sell the bonds. Longer dated bonds tend to be more sensitive to these changes in interest rates or inflation. It's also true that if investors feel confident about the economy, they're likely to buy equities and sell bonds. The recent success of our vaccine rollout and therefore the expectation that the economy will start to reopen again, combined with expectations for government stimulus, has led to higher expectations for future inflation, and this could have led to a sell-off in bonds. Here's a chart showing the yield on the US 10-year government bond and how that yield has changed over the last year. As you can see, the yield dropped quite heavily last March when the equity market fell, and that showed that people were buying bonds when they were worried about the equity market. However, more recently, you can see that yield has started to rise again, showing that people have been selling bonds as they become more comfortable with the equity market. The same is happening here in the UK. This chart shows the prices of a basket of UK government bonds that have maturity dates between 8 and 13 years away. Now this chart shows the prices of the bonds, not the yield, so it's almost opposite to the previous chart. You can see that prices have risen over the last couple of years, suggesting that people moved into bonds due to the lack of interest rates available elsewhere. However, more recently, in the last couple of weeks, these bonds have sold off, and in fact these particular bonds are down more than 5% over the last month. Government bonds are often viewed as a safe haven, but this is a helpful reminder that even government bonds can be volatile, particularly those ones that are very long dated. The mining sector has done well recently, as has historically been the case when inflation expectations are rising. Here's the share price chart for Rio Tinto, which is one of the biggest mining companies in the world. As you can see, the share price is higher now than it was before the pandemic started. About 50% of Rio Tinto's revenue comes from China, and we know that China has been spending heavily on infrastructure in order to boost its economy in the wake of the pandemic, and that has pushed up the price of iron ore, which is one of the key commodities produced by Rio Tinto. Rio also has exposure to copper, and that has also done well recently given the ongoing electrification around the world. Rio Tinto published its results this week, which came in ahead of expectations, and the company also announced a special dividend, which makes a nice change given the number of dividend cuts that we've seen across the rest of the FTSE 100 over the last year. We've mentioned the whole GameStop saga in the last couple of videos, but for anyone who missed them, just to recap, GameStop is a traditional video game company whose shares were being shorted by a number of hedge funds who hoped to make money from the share price falling further. On the social media site Reddit, a number of retail investors got together and agreed to buy shares in the company to push up the share price and cause losses for the hedge fund. A number of these retail investors use a trading platform called Robinhood, and Robinhood was forced to temporarily restrict trading in the shares because of the number of orders coming through. Overall, a number of hedge funds lost a lot of money because of the share price in the company going up, but later the share price did come down again, causing a lot of retail investors to lose money as well. The whole episode is now subject to an official hearing with the number of key players having to testify before Congress, and the title of the hearing, which started this week, is GameStop: Who Wins and Loses When Short Sellers, Social Media and Retail Investors Collide. Among the key players having to testify were the chief executive of Robinhood, the owner of a hedge fund called Melvin Capital, which lost billions due to the episode, and a prominent Reddit user who calls himself Roaring Kitty. The whole episode could have implications for future market regulation, so it is worth keeping an eye on. Looking ahead to next week, we've got lots of results out from UK banks, including HSBC, Lloyds Banking Group and Standard Chartered. That's it from us. Enjoy the weekend, and we'll see you next Friday.